Hello, and welcome to our journey into the world of Bitcoin. Imagine a world where money is not controlled by banks or governments. Sounds like a fantasy, right? But this is not a far-fetched dream. It's the reality of Bitcoin. Bitcoin is a decentralized digital currency, operating independently, free the clutches of any central authority. This revolutionary concept was introduced to the world in 2008 by an enigmatic figure, or perhaps a group, going by the name Satoshi Nakamoto. Unlike traditional currencies issued by governments, Bitcoin operates on a peer-to-peer network. There's no central bank, no single administrator, just a network of computers known as nodes, verifying transactions and adding them to a public ledger called the blockchain. Bitcoin, in essence, is a radical departure from traditional financial systems, offering a new way of thinking about money. It's a currency that's as much about a political statement as it is about financial transactions. Bitcoin, a revolutionary currency, breaks the traditional financial mold. But how does it work? Think of Bitcoin as a giant ledger shared by all users. But what keeps this ledger secure and reliable? To answer that, we delve into the world of blockchain technology. As the name suggests, a blockchain is a chain of blocks. But we're not talking about the kind of blocks you played with as a kid. Here, each block is a record of transactions. When a block fills up with transactions, a new block is created and added to the chain. This chain of blocks forms the Bitcoin ledger, and it's shared across the entire network of Bitcoin users. But how does a transaction make its way onto a block? That's where Bitcoin miners come into play. Miners are individuals or groups that use powerful computers to solve complex mathematical puzzles. The first miner to solve the puzzle gets to add the next block of transactions to the blockchain. This process is known as proof of work, and it's essential to keeping the blockchain secure. Now you might be wondering, why would anyone spend time and energy on such a task? Here's the catch. Miners are rewarded with Bitcoins for their efforts. This incentive system ensures that miners are invested in keeping the blockchain accurate and up to date. One more thing to remember is that each block on the blockchain has a unique code, called a hash. This hash is created using the information in the block, and it's incredibly sensitive to changes. Even a tiny alteration in a transaction record would create a completely different hash. This feature makes the blockchain incredibly secure because if someone tries to tamper with the information in a block, it becomes immediately obvious. So in essence, Bitcoin is a decentralized system where all transactions are recorded on a blockchain. The security, reliability, and accuracy of this blockchain are maintained by miners who are incentivized by rewards in the form of Bitcoins. So Bitcoin relies on a network of miners to keep its ledger accurate. However, where do Bitcoins come from? Miners are the backbone of the Bitcoin network, but what do they get in return for their efforts? Well, let's dive right in. The process through which new Bitcoins are created is known as mining. Picture it as a digital gold rush, where the miners are searching not for nuggets, but for blocks of transactions. When a miner successfully adds a new block to the blockchain, they're rewarded with a certain amount of Bitcoin. This is what we call the block reward. The block reward is essentially the incentive for miners to continue supporting the network. It's the carrot on the stick that keeps them digging. But here's the twist. This reward isn't a constant figure. In fact, it's designed to decrease over time. Every approximately 4 years, an event known as halving takes place. As the name suggests, the block reward is cut in half. The first halving event occurred in November of 2012, when the reward dropped from 50 Bitcoins down to 25. The most recent halving in the year 2020 saw the reward fall to 6.25 Bitcoins. Why does this happen, you might wonder? Well, the halving mechanism is a part of Bitcoin's design to control inflation. By gradually reducing the rate at which new Bitcoins are created, the currency aims to mimic the scarcity and value retention of precious metals like gold. The decreasing block reward means that mining becomes progressively less profitable over time, at least in terms of the number of Bitcoins earned. However, if the value of Bitcoin increases, then the smaller rewards could potentially be worth more in terms of fiat currency. It's a delicate balancing act, but one that has proven successful so far. The miners keep the network secure by validating transactions, the network rewards them with new Bitcoins, and the gradual decrease of the block reward ensures that Bitcoin remains valuable over time. Mining ensures the creation of new Bitcoins and the security of the network. But what determines the value of a Bitcoin? Tune in to our next segment to find out. Unlike traditional currencies, Bitcoin doesn't rely on a standard like gold or the economy of a country. So how do we determine its value? Well, the magic word here is supply and demand. Much like a rare piece of art, the value of Bitcoin is essentially determined by how much people are willing to pay for it. The more people want it, and the less there is to go around, the higher the price goes. It's a classic case of economic principles at play. But what makes Bitcoin's value so volatile? A variety of factors contribute to this. One of the key contributors is regulatory news. You see, when a country announces new regulations for, or even a ban on Bitcoin, it can cause a significant swing in the price. For example, when China, a major player in the Bitcoin market, announced a crackdown on cryptocurrencies in 2021, Bitcoin's value took a nosedive. In addition, changes in the broader cryptocurrency market can have an impact on the value of Bitcoin. Other cryptocurrencies, often referred to as altcoins, can influence Bitcoin's price. When altcoins rise in value, it can create a sense of uncertainty about Bitcoin's supremacy, causing its value to fluctuate. Another contributing factor is technological changes. Bitcoin's underlying technology, blockchain, is still developing and evolving. Any significant changes to this technology can influence the confidence of investors and thus the value of Bitcoin. Finally, market manipulation can't be ignored. Because the Bitcoin market is relatively small compared to traditional markets, it's more susceptible to manipulation. Large holders of Bitcoin, often called whales, can cause significant price swings by buying or selling large amounts of Bitcoin. So there you have it. The value of Bitcoin is a constantly shifting landscape, influenced by an array of factors from regulatory changes to market manipulation. It's a dizzying dance of numbers and trends, a true testament to the dynamism of the cryptocurrency world. The value of Bitcoin is a complex interplay of various factors. Now, how can one acquire Bitcoins? Bitcoins are not something you can find lying around. So how can you get your hands on some? Let's delve into the different avenues you can explore to acquire Bitcoins. First and foremost, buying Bitcoins on a cryptocurrency exchange is the most common method. Many reputable exchanges exist where you can trade traditional currency, like dollars or euros, for Bitcoins. These exchanges are essentially digital marketplaces where people can buy and sell cryptocurrencies. Just like with the stock market, prices can fluctuate, and you buy at what's known as the market rate. Another way to acquire Bitcoins is by accepting them as payment for goods and services. If you're a business owner, you can opt to accept Bitcoins from customers. This can be a great way to diversify your income and get involved in the cryptocurrency world. Mining is yet another method to acquire Bitcoins. But remember, Bitcoin mining involves solving complex mathematical problems, and it requires a significant amount of computing power. So it's not something you can do on your regular home computer, but if you're up for the challenge and have the necessary resources, it can be a worthwhile endeavor. Regardless of how you acquire your Bitcoins, you'll need a digital wallet to store them. Think of this as a virtual bank account. Your digital wallet can be web-based, or it could be an app on your smartphone. Some people even opt for a hardware wallet, which is a physical device that securely stores your Bitcoin offline. It's important to note that while acquiring Bitcoins has become more accessible over the years, it's not without its risks. The value of Bitcoin can be volatile, and there's always the risk of digital theft. So it's crucial to take steps to secure your digital wallet. In summary, whether you buy Bitcoins on an exchange, accept them for goods and services, or choose to mine them, there are various ways to acquire this digital currency. Acquiring Bitcoins has become increasingly accessible, but remember, with great power comes great responsibility. Bitcoin, like any investment, comes with its fair share of risks and rewards. The rewards of investing in Bitcoin are truly enticing. It offers the opportunity for significant profit, especially for early adopters who have seen their initial investment skyrocket over the years. Furthermore, Bitcoin provides freedom from traditional banking systems, offering a decentralized global currency that can be accessed anywhere, anytime. However, it's not all sunshine and rainbows. The risks are just as real. The most notable is the extreme volatility of Bitcoin's value. It can soar to breathtaking highs and plummet to alarming lows, all in a matter of days. This unpredictability can lead to significant losses if not managed carefully. Additionally, Bitcoin's digital nature makes it susceptible to potential loss or theft through hacking, a risk that traditional currencies don't face to the same extent. Bitcoin, a currency of the future, holds immense potential. Yet it's vital to tread with caution and understand the risks involved. As we come to the end of our journey into the world of Bitcoin, let's take a moment to recap what we've learned. We've uncovered the basics of Bitcoin, how it works, and how it's mined. We've delved into the factors that determine its value and explored the ways to acquire it. We've also weighed up the risks and rewards associated with investing in Bitcoin. But remember, this is just the tip of the iceberg. The world of cryptocurrencies is vast and continually evolving. It's essential to stay informed and keep learning. Whether you're considering investing in Bitcoin or simply curious about this revolutionary technology, every bit of knowledge counts. As we wrap up, we encourage you to continue your exploration of Bitcoin and other cryptocurrencies. It's a fascinating field, and who knows, you might just find yourself at the forefront of a financial revolution. That's all for our journey into the world of Bitcoin. If you enjoyed this video, don't forget to like, subscribe, and share it with your friends. Stay tuned for more exciting content on this channel. Until next time, keep exploring, keep learning, and most importantly, stay savvy.